Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Case Studies in Partner Succession. Before we begin, we need to cover just a few important items. First, please take a moment to close any other programs that you have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive those credits, you must complete two requirements. The first is that you participate in all 4 of the polling questions. And please note that partial credit will be given for those who answer 3 out of the 4 questions. The next is that you must complete an online evaluation. This will appear on your screen immediately after the end of the webinar, so please take a moment to complete it before you close your web browser. Once you've met both requirements, you'll receive your CPE certificate by email. That'll be within 10 business days, but most likely by the end of the week. Now, in order to fully participate in the webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. You should see that on the right-hand side of the screen. There's an orange arrow near the top, which you can use to minimize the control panel if you wish. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of the control panel. Just type your question in the box and click send. As you can see, Terry is sharing his webcam during today's presentation. You are certainly welcome to resize, minimize, or even close that if you wish. On the next slide, you'll see a list of our upcoming CPE webinars. Our President, Joel Sinkin, will be presenting 4 more sessions with CPA leadership before we take a break for tax season. The November 28th and January 15th sessions, you can register for those for free if you follow the link on our website. So go to the CPE courses section of transitionadvisors.com for more information and to register there. Finally, as a reminder, you should have received an email about an hour ago, and in that there was a link to download the slides for today. But I just sent it via the chat box as well. If you have any issues downloading that, or if you'd like me to send it as an attachment to an email, you can just reply to that message you got, and I'd be happy to send you a PDF of the slides. Now I'd like to introduce our presenter for today. Terry Putney is the CEO of Transition Advisors. Thank you so much and enjoy the webinar.
Thank you, Nikki. One additional item here, if you have any questions, please submit those through the chat box, or feel free to send me an email anytime after the webinar. I'd be happy to answer by email, or if you prefer, I'd even be happy to have a short phone conversation about anything that we bring up today that interests you, or that might have a question about how it pertains specifically to your firm. I wish I could sit across from each of you individually and just go over your individual situation. I'll try to address as much as I can in a generic way. Hopefully you'll find this interesting. I think you will. A little introduction to Transition Advisors. We work strictly with accounting firms on a national basis in the area of ownership transition for accounting firms, and that falls into 2 primary areas. One is mergers and acquisitions, and we're involved significantly in that area. We help firms find each other, negotiate deals, structure deals, understand the market that they're trying to work in within the accounting profession, the entire transaction support from start to finish. And we also work in the area of ownership agreements, and that's what today's webinar is generally focused on, helping firms both with internal succession, building owner agreements, succession plans, and so forth. We're going to go over 2 case studies today, but before we do that, I want to get into what some of the basic issues are with respect to the issue of partner succession in CPA firms. And the webinar today is going to fall into 4 general areas. One is understanding your firm's, the timing of the need within your firm for partner succession. And that may seem like an obvious question, but the real issue there is, when do you need to start the business plan that will lead to a successful transition of partners within your firm? Second, assessing the strength of your bench, the candidates that you have in place for that'll become new owners who will become the successors for your partners. Third, the owner agreement and the terms that drive both the buy-in and the buyout of partners. And finally, the actual transition of partner duties, which tends to get sort of overlooked or dealt with after the fact and actually needs to be anticipated early on in the process. With that, this is the first polling question. We'll get the first one out of the way. Give me an idea of who's on the line with us. Nikki?
Okay, thanks, Terry. The first polling question is pretty simple. How many equity partners do you have in your firm? So please take a moment to submit your answer. Okay, everybody's answered. Go ahead and share the results there. So 47% have just one equity partner. Another 47% are in that 2 to 4 range, and then the remaining 6% have 5 to 9 equity partners.
Okay. That'll give me a good indication of how to position our comments today. So in looking at your firm's readiness for partner succession, one of the first things you need to ask yourself is, looking at all the individual partners in your firm, and for most of you on this call, that's not obviously difficult to do. Either you're looking at yourself, or maybe you're potentially one of the successors for the owner of the firm, or you're looking at a partner, in a few cases, several partners. So the first thing you need to ask yourself, and for most of you, it's going to be a role succession answer. Role reallocation implies that we don't need to replace a body with a body at the partner level. We have enough partner capacity that we can spread around an exiting partner's responsibilities to the others in the firm. Role succession means that we need to replace a body with a body, and that could be either because of capacity, or it could also be because of special expertise. A partner, for instance, that might be involved with an industry specialty that no other partner has in the firm would have to be replaced with somebody that has that specialty in order to carry on those duties. Again, this isn't rocket science, but it's important to understand that, because as you go forward, you want to make sure you understand both the timing of the need for replacing a partner as well as the kind of replacement you need to go through. So in this example, and this is actually the type of template that we use oftentimes in partner retreats when we're dealing with how to position the firm's readiness for replacing partners or partner succession. In this example, we've got a partner who needs to be replaced within the next 1 to 3 years. And actually, because of the firm's ability to have enough capacity at the partner level in this example, would not need to replace that body. So all we need to deal with in that case is a proper transition of that partner's duties. Looking out further, though, into 4 to 7 range in this case, we have 2 partners that are going to be leaving that, in fact, we do need to replace a body with a body. So the idea here is that we need to work backwards from that projected date and make sure that we've got candidates in place to make that replacement in time for not only for them to develop properly so that they can be an adequate successor, but also in time for them to execute the transition plan or help execute the transition plan of those partners. And then, of course, in this case, we have, after 8 years, 2 partners, one who probably won't need to be replaced because we expect to have the capacity that we need at that time, but one that, in fact, would need to be replaced, and possibly because they have a special expertise that will need to be replaced. So that helps you understand the timing of the need and the type of replacements you need to go through. It's an exercise I recommend each of you do. Of course, if you're a sole proprietor, then you know you have to be replaced with bodies. You know you have to, your whatever expertise you bring has to be replaced. But in a multi-partner firm, this is an important exercise to go through. The next is assessing the readiness of your candidates to actually become a successor. Now, for those of you on the line, I know there's a couple of you that are clients of ours or former clients of ours. We've probably gone through this with you, so this is old hat. This is an example of the type of characteristics that most accounting firms need to have in their partner group in order for them to be successful. Again, not rocket science. Some of these things are things that you can actually put numbers on. Client management would imply how large of a book of business a person's able to manage. Personal productivity, of course, gets into the issue of billable hours. Growth in client services and relationships implies, practice development activities. Many of these things, though, are not things that can be measured. The important thing that I think is the important use of this tool is because I can't tell you how many times I've sat around a table of 5 partners who are we're assessing the quality of the bench and the readiness of certain people to become partners in the firm. And there's a disagreement about whether Sally or Joe is ready to be admitted, but nobody can really put their finger on why. It's sort of a judgment call. Oftentimes I find it isn't even really about Sally and Joe. It's really about the firm's readiness or the firm's reluctance to admit new partners for a variety of reasons. This tool gives you a clear-cut benchmark of how to assess an individual's performance, current performance, and where the gaps exist, and gives you the ability to have a plan in place that will overcome those gaps. Generally, there's 3 different ways that you want to look at partner development staff into partners, and that is first, what I call on-the-job training. We used to have, when I was way back when I started in this profession, we had actually a time code in our time and billing system called OJT, which was on-the-job training, and that is how you assign tasks to people so that they can develop and demonstrate their skills. The second is, of course, mentoring, which is an important tool that I see that's vastly underutilized within accounting firms, where we just have a one-on-one relationship with our candidates and talk about where their strengths and weaknesses are and how to overcome those and what the firm's expectations are for them. And then the third is, external training. And there's several excellent programs available, and I'm happy to give you a list of those if you're interested, that specifically are designed to help accelerate the development of partner candidates in a CPA firm. So using those 3 techniques and understanding where the gaps are in your candidate pool will help you accelerate the development of candidates to be actual partners. When you go through that mentoring and you're going through the evaluation, I think one of the things that again gets missed is an understanding of how committed your candidates are, in fact, to become a partner in your firm. Oftentimes I'm working with firms who have certain people that they've identified as potential, and I'll ask them, well, how do they feel about it? Well, we haven't talked about it, which to me is obviously a huge hole in the plan. So the first thing is to understand how committed they are, how interested they are in actually taking their career to that level, and not making an assumption that they are just because they have certain skill sets. The second is giving them an opportunity to actually demonstrate their abilities in the area of becoming a partner. And an excellent tool for doing that is either a non-equity or a principal role in the firm. Typically, a non-equity partner would have all of the responsibilities, especially in the client service area and firm management area, that an equity partner would have without actually owning any of the firm and being involved in the large business or the overall business decisions of running the firm. So a non-equity partner path would typically be a 2 or 3 year role in which you'll be able to evaluate whether a partner candidate has what it takes to actually become a partner in the firm. There's really 3 different ways. We're seeing the use of non-equity partners becoming much more popular within CPA firms. And some firms call these principals, by the way. And those 3 different tools or 3 different reasons for having non-equity partners would be, just as I mentioned, as a staging area for your future partner candidates. The second tool is actually very helpful in mergers and acquisitions, where we're typically bringing someone in who's going to be transitioning out in the next, say, 3 to 5 years. And rather than put them in an equity position and dealing with all that means, but keeping them in the role of a partner in the firm with respect to client service, we might put them in a non-equity partner role, which would oftentimes be accompanied with some special contractual commitments with regards to their final buyout or a compensation arrangement. And then the third tool is to use it for people that we want to give the responsibilities of a partner, but we realize will never really be able to perform at the level of an equity partner. And we're going to believe in a permanent role as a non-equity partner. I think one of the things you got to guard against in that case is, first off, not having too many of those people. And secondly, making sure that everyone understands that that person is not in the way of promotion of other people to an equity status. I'm seeing too many firms that are willing to make a person a non-equity partner just because it's a title, and all of a sudden we think we've got a bench when in fact nobody on the bench is strong enough to actually take over for the equity partners. In the area of owner agreements, the three things, and we're going to get into this in just a minute here in greater detail, is assessing the affordability of the buyouts and the retirement obligations. Oftentimes, when I get started with firms who have owner agreements that feel like they're unaffordable, many times they are unaffordable, but sometimes it's not that. Sometimes it's because they just don't feel comfortable that the overall plan for bringing new partners in and transitioning to that new partner group, along with the buying out of partners, that whole plan is just not strong enough. They just don't understand how it's going to work, and so they tend to place most of the blame on the fact that we can't afford the buyouts. I'll get into, throughout this presentation, a way of assessing the affordability of buyouts and retirements so that you can understand either how your current agreement will or won't work, or as well as how to build a plan for those of you that don't have one. The second is the most important thing, I think, in any of these succession plans is the understanding that the value of your firm, the overall value of your firm, is primarily based on your ability to create a strong transition plan of the duties and responsibilities that partners have to their successors. In most CPA firms, the partners are responsible for, the primary people responsible for client relationships. Those relationships can tend to be very personal, and without a proper transition plan, much of the value can be lost because obviously the clients are lost once the partner leaves. So understanding the need for the transition plan and how to make sure that everyone is actually executing it is an important part of succession planning. And then finally, the thing that we're running into often as well is how do we bring in new partners? What should the deal look like? In many firms that are oftentimes run by founders have never had to go through this before. They really don't know how to do it, what makes sense, what will make sense for both parties. So I'll give you an example of how to assess affordability. It's a very simple example. It's $1 million firm owned by one person, a sole proprietor who's operating in an S corp with a 38% profit margin. The owner generates about 1,300 billable hours, or about 325,000 in annual production on his own time. And that's an important thing to understand, because once that partner is no longer, that owner is no longer a part of the firm, that production has to be replaced. Of course, replacing that partner is more than just replacing the production, but there at least needs to be enough bodies in place that are producing that much revenue that, or else we're going to lose that revenue because we don't have the capacity to produce it. And finally, this particular example, the firm has about $250,000 in receivables and work in process, which is about normal for $1 million firm, about 25%. So when we look at the value of this firm, we're going to assume in this case a 1x multiple, or about $1 million for the intangible value. The value of the firm is actually two pools of value. One is the intangible value, which we typically associate with the client base, with the fees. You might call it goodwill. The second portion of the value is the tangible value, which is generally what your accrual basis balance sheet equity is. In this case, without taking into account any cash that might be on the balance sheet, and any other assets that typically there aren't very much in the way of other assets that have any value in an accounting firm. it's mostly the receivables and work in process. With respect to the 1x multiple, I'll tell you that there's clearly a trend in the profession for those multiples to come down. The benchmarking surveys, the Rosenberg survey, for instance, is a good example that measures what multiples are being used in owner agreements. Typically, will tell you that the average right now is closer to 80% rather than 1x. I think that what we're finding is that the larger the firm, the lower the multiple will tend to be. I think that has something to do with concern about the ability of the firm to afford buyouts. And the smaller the firm, the higher the multiple will tend to be, although it's very rare nowadays for the multiple to be over 1x. I think many small firms would consider themselves as having as an alternative the ability to sell the firm, and in the marketplace, generally the multiples will be a little higher than they'd be in an internal buyout. And we could spend quite a bit of time talking about why that is. Don't really have time to get into that today, but that is generally the case. So, for instance, a sole proprietor with $1 million practice probably could fetch a 1x multiple in the open market if they're in a large enough market and they have a good enough firm. But so they might look at that as an internal valuation as a reasonable alternative. But again, in this case, we're going to value the firm in 3 buckets. Actually, the stock needs to be dealt with as well. I'm going to deal with each of these 3 separately in this plan. And we're going to use a 10-year payout. So in this case, as an example of how to assess affordability, this owner is making $380,000. As I mentioned, we're expecting a replacement cost of about $130,000, which is the cost of replacing the owner's production. That leaves about $250,000 for us to do that we need to use for 2 different things to make this affordable. One is pay for the buyout, and 2 is leave enough behind that the new owners of the firm would find it, beneficial to actually do this. I mean, if they're going to spend the next 10 years doing nothing but paying off the former owner, why would they do that? Where's the upside? So in this case, because of the $1 million valuation on the intangibles, that's over 10 years, that's about $100,000 a year. Typically, we don't see interest added on to the payments. It can be, but it just adds to the cash flow, obviously. And then the second pool of value is the tangible value, which in this case was $250,000. Again, over 10 years, that'd be $25,000 a year. So the residual in this analysis is about $125,000, which is about 50% of the available capital. That's generally my rule of thumb of what we want to achieve as a minimal residual. Hopefully, it's going to be higher in many cases, but in that case, we're basically splitting the pot between the buyout proceeds and what we're leaving behind for the remaining partners. The things that could make this unaffordable that sometimes we run into, I mentioned the interest factor. It may seem like, well, why wouldn't you pay interest on the deferred payments? I mean, shouldn't you pay interest on borrowed funds? Adding a 6% interest rate, which, nowadays is actually not much more than prime, actually adds 30% to the payments. So in essence, when you're comparing a firm who would add a 6% interest rate on their deferred payments in an internal buyout with a firm that doesn't, the firm with the interest rate is really valuing their intangible value at 130% compared to 100%. Trying to make the payments over 5 years instead of 10 obviously doubles the annual cash flow. In this case, would mean that there'd be no residual for the first 5 years of the transition plan, which again would probably be unacceptable to the successor partners. Trying to make the payout in the form of stock. Again, remember this was an S corporation, so we have to deal with the fact that it's a stock. There has to be stock involved, but in order to, unless we can somehow use a personal goodwill tactic, which is possible in some cases, it's more likely that the payments would be paid in the form of deferred compensation. If we try to pay it in the form of stock, we're in essence adding about a 60% premium to the buyout because we're having to deal with the payments in after-tax dollars. Using a 40% tax rate, that equates to about a 60% premium. Or in the case of a firm whose partners are responsible for a very high percentage of the firm's productivity. Going back, and let me go back to the last slide. If that replacement cost was a lot higher than $130,000 because the production was so high, you can see where you'd have less capital available for the buyout. So a firm that depends heavily on their partners for production actually can create a scenario where the valuation should be lower. And I'll give you an example of that in one of our two cases. As far as how to determine value and allocate the value, there's three approaches that are common in most owner agreements. One is the equity method. The equity method says one of the partners owns X% of the firm, be anything, 20%, 60%, 90%, which is actually what we're going to have one of our case studies here in a minute is going to use a 90% equity. Oftentimes, firms that are founder-driven will use the equity method. Smaller firms tend to use the equity method. At some point in time, we all decided this was the right allocation of the ownership. It may have been because we came together with existing books of business and one partner had a $600,000 book and another had a $400,000, so we'll be 60-40. The equity system tends to be very awkward as the firm matures, and it becomes very awkward when it comes to when we try to bring in new partners, because that value is set in stone. It doesn't tend to change, and if it does change, it requires somebody writing a check to somebody else, which doesn't actually equate with what's going on in the firm, which is the firm is typically being the growth of the firm is being driven through sweat equity. So the sweat equity tends not to get recognized when you use the equity system. The second one is a compensation multiple system, and you've probably heard of firms that use 3 times average compensation for the highest 3 of the last 5 years as their retirement benefit, which would usually equate to the intangible value. The compensation system kind of arose out of a different way of starting with the same overall valuation, but allocating it differently than the equity method. So 3 times comp in a firm that has a 33% profit margin is the same as 1 times revenues, but it allocates the value in a very dynamic fashion because compensation tends to be dynamic. So compensation becomes the proxy for how to allocate value within the firm. And then the third system, which is one that I use frequently, is the AAV or unit system. And I'm going to go into an example here in a minute of how that's used. In the AAV system, we convert the volume of the firm into units, and it's usually $1 of volume equals 1 unit. We don't have to price the units at $1 when it comes to buying out or creating value. We can price it at a different number. In this example, say 80 cents. So what we're in essence is saying that we're valuing the firm at 80% of revenues. We can allocate the advantage of this over the equity method is that these units can be allocated in a dynamic way, the same way compensation is typically allocated. In fact, we can use compensation as the basis for how we allocate the units. Normally, units are allocated with some performance measurement in mind. So let's say we start with a firm that has $3 million in volume and 3 partners who all own 33% of the firm. So we might start off, if we convert from that equity system to the unit system, and allocate 1 million units to each of those 3 existing partners. We bring in a new partner, and rather than require that new partner to buy a significant portion of that intangible value, we'll just not allocate them any of that intangible value up front. And then as the firm grows, say it grows from $3 million to $4 million, with that new partner in place, we start sharing that growth with the new partner by allocating some of those additional units that are created to that person as those units are created. And it can be on the basis of anything you want. It can be based on their individual performance relative to the other partners. It can be based on their compensation relative to the other partners. It can be based on a plan to actually have them achieve a certain amount of allocation. But the point is that by doing it that way, we're recognizing the sweat equity that that partner is bringing to the table and is helping create value in the firm. As we buy units back from the partners that have been allocated them when they retire, that's another place where sweat equity comes into play. And the partners that are in place at that point who are responsible for making the payments to a retired partner would then be allocated the units that are being reintroduced back into the firm from the retired partner. So again, that's another level of sweat equity that's being recognized in the use of in the allocation. There's an article that we wrote for the Journal of Accountancy that you can find on our website, which is gets into more detail about how this system works. And I recommend you read it if you're interested in it. I found that this system is a tremendous way of transitioning from the equity method to another method, especially when you're in a position where you need to start admitting new partners into the firm. And then finally, the fourth piece of this that is important is the whole transition plan. Our rule of thumb is that, and we see this in many owner agreements nowadays, is to require an understanding that it's going to take about 2 years to transition the main responsibilities, which are oftentimes client relationships, of a retiring partner. So the rule of thumb is 2 years. And so when you go back to that template that I showed you earlier, where we had the anticipated retirements of partners, the first thing we need to recognize is we got to work back at least 2 years to make sure people are in place to actually conduct and participate in the transition. And oftentimes we want to be in place even before that. But that 2 years is an important milestone to keep in mind. We recommend that in addition to requiring a 2-year notice from partners in your owner agreement, that you also require that a formal written transition plan be executed. So when a partner gives their 2-year notice that they're going to leave, the firm and the partner would jointly put together a formal transition plan. And if you're interested in what a generic one of those looks like, drop me a note at the end of this presentation. I'd be happy to send you a copy of a generic transition plan for an internal succession. And then we recommend that both of those be a requirement in the owner agreement. So the owner agreement would require a 2-year notice, and the owner agreement would require execution of the plan. A failure to execute the plan to the satisfaction of the firm would trigger whatever penalties are in place if the 2-year notice wasn't given. Of course, that needs to be accompanied with proper notice to the transitioning partner that they're not, in fact, executing the plan adequately. We see the penalties can be either in the form of making the buyout contingent in a small firm where partners are responsible for specific books of business. That might be the right way to do it. So rather than set the price at the date of retirement in a fixed fashion, we actually make the price of their buyout contingent on retention of clients for maybe 2 years following their retirement. Another approach that is more popular when you don't want to really have a book of business culture within your firm would be to have specific percentage reductions in the buyout for failure to provide notice or failure to execute the plan. So, for instance, if you fail to give the 2-year notice, you might have anywhere from a 20 to 40% reduction in the retirement benefits that are available. That leads us to the next polling question. I'll turn it back over to Nikki.
Hey, thanks, Terry. The second polling question is on your screen. This one's about owner agreements. Does your firm have one? So yes, and everyone signed it. Yes, but not everyone has signed it. No, but you think you need one. No, and you aren't sure that you need one. This is our second polling question. If you missed the first one, that's okay. We'll still have 2 more after this, and as long as you complete 3, you'll still get your CPE credit for today. I'll leave the poll open just a few more seconds. It looks like we have nearly everyone submitting their answers. Okay, that poll is closed. So 31% say yes, and everyone signed it. 38% no, and they need one. 25% aren't sure that they need one, and then the remaining 6%, they have one, but not everyone has signed it.
I always find that interesting, and that I do run into that a lot, by the way. Firms that have owner agreements that have not been signed. Oftentimes it's because they maybe went to a lawyer and got an agreement put together, and they looked at it and said, you know, it's got all the legalese in it, but there's something missing here. And what's typically missing is an understanding in the agreement of the business plan that backs up the transition and buyouts of accounting firm partners. You know, lawyers are great at, and I hope there's no lawyers on the this call, and even if there are, I don't mean to disparage the entire profession, but lawyers are great at the contractual part, but sometimes they don't understand the business plan that needs to back up these agreements. And so people say, yeah, it looks good, but I'm just not comfortable. Something's missing. I'm uncomfortable with it. I'd say about maybe 20% of the projects I get involved with owner agreements, there's an existing unsigned agreement that we're starting with. Okay, this is our first case. This firm is and had I known we were going to have as many sole proprietors and 2 partner firms on the call, I would have maybe used a different case. But I can make this work. The issues with this particular firm could have easily applied to your firms as well. In this case, we have a 10-owner, $9 million firm that has a very old, obsolete owner agreement. It had been in place about 20 years. And then the second case is a $7.5 million firm with only 2 partners. They were actually the founding partners. They need a new agreement because the partner who actually owns 90% of the firm is ready to transition out, and we need to get new partners in, and we need to figure out how to buy him out. So those are the 2 situations we're going to go through. Just to give you an idea how we approach these engagements, our first step is to obtain financial and operating data on the firm and all of the key constituents, including the owners as well as the candidates that are being considered for ownership. So we get an individual demographic view of each of the constituents, so we understand who the players are. Then we'll interview the management team to gain an overall understanding of all the issues, make sure we kind of know where they're coming from, and we start at that point begin to float alternative approaches to how we might create a solution. And then each of the individual owners is interviewed, and we're oftentimes able to do this offsite, by the way, without having to be in your offices. That holds down the cost, of course. And each of those owners is then able to give us their specific perspectives, what concerns they have. We're able to understand what preconceived notions they have about how this should go. And we're also at that point able to start talking about where we think this might be headed so that we can start building consensus amongst the owner group for the solution. We'll also interview, oftentimes, not always, candidates to determine whether they're suitable as a candidate, to make sure they're committed, that they understand what the plan is, what the overall solution might look like. We'll circle back with the management team, with our recommendations, and then follow that up with a written report on our detailed recommendations for the plan and for the new agreement. And the idea is that report will hopefully have gained enough consensus by the time it's issued that the owners are able to agree to it without a lot of disruption. So back to our first case. Again, it's a $9 million firm with a 30% profit margin, 10 shareholders, ages 42 to 67. It was a C Corp. They had a fairly significant amount of WIP and receivables, but more importantly, they had a tremendous amount of debt, which is something we run into, I'd say, in about a third of the firms we work with. And it can really create problems, especially if you're trying to sell your firm when you have a tremendous amount of debt on the balance sheet, or really any significant debt, because that debt typically has to be resolved at the time of closing. And when the debt I'm talking about isn't debt to acquire, isn't debt that you might owe to a seller of a practice that you bought. Usually that can be continued. What I mean is external bank debt. And it really, what it does is it creates a need for a liquidation event in order to satisfy the debt, which typically is inconsistent with the terms of what you're trying to do in a merger or acquisition. So in this case, it actually created problems for the firm in an internal transition as well. We had one shareholder who was in transition already and one that was 3 years out. Additional situation with this particular firm was that the shareholder agreement was deemed to insufficiently value the firm, and the allocations of that value were also not considered fair by most of the shareholders. We had one of the partner that was 3 years out, or the shareholder that was 3 years out, actually had a specialized skill that no one else in the firm had, and they hadn't done anything to address how they were going to replace that. And then there was just an overall dissatisfaction amongst about probably 7 of the 10 partners on the agreement itself and whether or not the firm could actually pull off succession. In this case, in order to be conservative, they had valued the owner interest based solely on the accrual basis book value. So there was no intangible value at all associated with the value of the firm. And on top of that, because we had so much debt, there was only about $900,000 of net value to allocate. And remember, this is a $9 million firm. So in a typical firm like that, without the debt, you'd expect to have a valuation of somewhere between 7 and 9 million for the intangible value and another 2.5 million for the accrual basis value, for a total value of somewhere between 10 and 12 million. And in this case, it was 900,000. And not only that, but almost all of the 900,000 was actually allocated to 2 of the owners. I think 5 of the owners had negative value assigned to them because of the way they were setting up the allocation of value. And although they weren't required to pay that back when they left, it meant they had 0 value. So for the most part, most of the partners in the firm looked at the value of their firm as being worthless, which tended to create a tremendous amount of dissatisfaction, as you can imagine. It also created sort of a, what have I got to lose? I mean, I really don't care. All I'm trying to do here is make a paycheck. It was amazing how demotivated many of the partners were in the firm with respect to the future of the firm. They were kind of disengaged. One thing I would say for them is they did have a one person, one vote culture, so that even though 2 of the partners were assigned most of the value, even though it was small, they didn't control the governance of the firm, which oftentimes can be the case. So our recommendation was to leave the accrual basis book value as the stock value. And remember, this is a C corporation. Now, typically, I wouldn't recommend that because that's an inefficient way to pay out that value. You've got to use after-tax dollars, and had they had a $2.5 million accrual basis book value, they would have had to generate $4 million in profits in order to have enough left over to buy out all the stock. But in this case, because of another recommendation we made here that I'm going to talk about in just a second, I felt like the accrual basis book value was the right way to assign that part of the value of the firm. We recommended they adopt a deferred compensation plan, which was based on a conservative 2 times average comp paid over 10 years, which would then create an intangible value for the firm. In order to pay off the debt, and I don't know that the firm has actually executed this, but we recommended that they raise capital from the shareholders. In talking to the shareholder group, I had actually floated that idea, and several said they were more than willing to do that. To pay off the debt, issue more capital, and without changing the equity of the firm in terms of governance. And so those that were able to bring capital to the table would do it because of a return on investment that I suggested be set as high as 8%. I said, you just keep raising it until you get enough capital in place to pay off that debt. If it's 8%, great. If it's 10%, so what? I mean, I think it's important to get rid of the debt. One of the things that we did with respect to the specialty shareholder was we created a waiver for that person, and it's not a positive waiver, meaning that their buyout would have to be contingent based on retained business because they just didn't have somebody in place to take over. The idea was that they would, in fact, create a business plan. They had candidates in place that potentially could be successors for this person. So the idea was that this would create the motivation for that partner as well as the rest of the firm to address that succession issue and get those people in place so that didn't become a risk for the retiring shareholder. We also recommended that they not replace the first, I think, 2 partners besides the specialty shareholder who had to be replaced. 2 additional line partners in order to increase the profitability. We felt the firm was over-partnered, and they sort of agreed with that they should be actually more like a 7 or 8 partner firm as opposed to a 10 partner firm. And then we recommend they put in place a mandatory retirement age of age 65, which would also help drive the over-partnering issue. So the affordability test in this case, keep in mind that we've got 10 partners making roughly about $300,000 apiece. The replacement cost in that case was about $120,000 for each of them. That left $180,000 of net capital. The stock buyback, which would only apply for the first 5 years, would have been $20,000 a year, and the deferred comp, the new portion of the value in the agreement, would have been $60,000 a year for 10 years. So our residual would have been $100,000 or $120,000 of net of the capital, which was roughly about 67% of the available capital. So therefore, affordability was demonstrated in this case. Going to turn it back to Nikki for another polling question.
Okay, this is the third polling question. This one is, how many partners in your firm will likely slow down over the next 5 years? Is it none, all, most, or some? Okay, great. That was quick. Everybody's cast their answers. 53% say all, 29% some, 12% most, and the remaining 6% none.
Okay, so those of you with all, obviously you are at a critical point where you need to start making decisions. I'd say 5 years is kind of the minimum. At that point, you really need to have in place a plan. So hopefully you're using this webinar as a starting point to start building that plan. Be happy to help you work on it, obviously. The second case that we're going to talk about is a firm about $7.5 million with 2 partners. One owns 90%, the other 10%. And actually how that happened was that the firm was originally part of another firm that broke apart. At that point, 2 partners each owned 45% of that other firm, and 2 owned 5%. They'd gotten their 5% because they'd just been admitted as a new partner, and rather than mess around with what that meant, they just kind of gave them a token 5%. So when the new firm formed, when that firm split up, They just basically let the math take over. So 45 times 2 is 90, and 5 times 2 is 10, and that's how they ended up. And actually that worked because there really wasn't anything that 90 and 10 were ever used for up to this point. So it didn't matter that one owned 90 and one owned 10, and the one that owned 90 was the dominant partner. I mean, he was bringing most of the business in. He was managing much of the client relationships, and over time had developed a fairly strong bench. There were 5 non-equity partners in place that were being considered for promotion. The 90% partner was ready to retire, and he was flexible about his timing, but really wanted that to start fairly quickly. So the project in place here was to decide how to bring in these 5, how to, and even if to bring in these 5 non-equity partners, how to value the firm and for the buyout of the 90% partner, and what the overall plan should be. So majority partner wanted to come in as soon as possible. There was some uncertainty about whether or not to bring in all the non-equity partners. In this case, this is an example of a firm that relied heavily on partner productivity. In fact, the 90% partner, believe it or not, was generating 2,000 billable hours a year. The lowest that any of the group, including the non-equities, was generating 1,600. Both of those are way over average. The average in the profession for equity partners is around 1,200. We see firms that pretty normally can function with 1,300, 1,400. You start getting more than that, and it becomes a cultural issue. It doesn't mean you're wrong. It doesn't mean you're bad. It just means you're different, and it can create problems when it comes to succession. The current operating agreement they had in place actually was one of those that was not signed. It'd been formed about 3 years ago, and they never signed it because it really didn't address what the real issues were. So the first thing we did was deal with the most important issue, which was not how much we were going to pay the managing partner, not whether or not to bring in the non-equity partners, who was going to run the firm when he left. And the obvious candidate was the 10% partner, although nothing had been done to actually put in place a plan for him to become the next managing partner. So we talked about that plan. We made sure he was ready to do it. We talked about how long it would take. And in fact, even though the 90% partner wanted to leave in about 2 years, we mentioned the fact that we think that's too quick for this transition to happen with managing partners. So we put in place actually a 3-year plan, in order to make sure that we had a strong handoff of the leadership role of the managing partner. And then we did an assessment of the 5 non-equity partners. And I'm not a HR expert. I'm not a personality profile type of person, but in looking at the way that what their duties were, how they were performing, what their attitude was towards this whole plan, the things that we took into account were, of course, what were they currently doing, and each of them was managing anywhere from a $400,000 to $735,000 book of business, and each of them was bringing some new business into the firm. I think this is a concern. The most that anyone was bringing in was $50,000. And in a firm of $7.5 million, you probably need to be able to replace something like $350,000 annually in new business development just to stay even. So the group, as it currently is constituted, wouldn't be producing that much, but there was an understanding that needed to ramp up, and the hope was that once they became full equity partners, that they would be able to be more successful with practice development. We actually cut one of the 5s because they were too old. That person was, I think, 64 years old, and there wasn't any reason to bring them into an equity role when they probably would be in that role for maybe less than 5 years. So instead, we created a special deferred comp arrangement for them to give them recognition of the value that they actually were bringing to the firm, but it was outside the standard owner agreement. So the plan was that the managing partner would stay in a full-time role for 2 more years. The new managing partner would be installed this January 1st. This engagement is actually not completed yet. We're almost done. And the 4 non-equities that we decided to keep would be admitted as non-equity partners on January 1st. So then the next thing that became important was the managing partner buyout. He felt like that he could carve out, and I can see where that somehow carved got lost in the slide. I'm sorry. It's interesting. We carved out $500,000 worth of clients that he had a very personal relationship with, that he was going to retain, at least temporarily. It helped not only to help him maintain some cash flow, because he would be, his compensation after he went from a full-time role to a part-time role would be enhanced with the profits on this $500,000. It also helped cut down on the amount of buyout that we were going to have to give him. And then we sold 20% of the tangible equity back to the 4 new partners. Now remember, the tangible equity, I'll go back here, was $1,750,000, and so 20% of that is $85,000 each, and that's what we charged each of the 4 new partners, and that could be paid over a period of time. We didn't ask anybody to write a check for that, although that could be done with the use of some bank financing potentially. The remaining tangible equity, which was be $1,400,000, that would have been allocated to 90% of that would have been allocated to the managing partner, was to be paid over 10 years. And then we, I think that left $1,200,000 actually for him. And then the intangible value, we were set at 50% of fee volume, which is pretty low. But when you consider what he was making, which was $1,200,000, and you consider how that relates to the volume of the firm, his compensation was only about 18% of his relative volume in the firm, and so it would have been unrealistic to pay a standard, closer to 1x or even 80% of X, 80% of fees as a valuation metric, because it just wouldn't have been affordable. I'll walk you through how that works now. So remember, this guy is generating almost $800,000 a year on his own time. So his replacement cost was substantially high in this evaluation. His compensation at $1,200,000. That only leaves about $880,000 of net capital. So the annual buyout of his tangible value was $140,000, and the annual buyout of his intangible value under this plan was about $250,000. So the residual was $490,000. Had we tried to do something at a more standard sort of valuation metric, we would have ended up with hardly any residual whatsoever. Fortunately, in this case, this guy was reasonable about the valuation. It was more important to him that we have a successful transition of the firm. We installed the AAV unit system as a new system, primarily to use for the new partners. There would be 5 new equity or 5 partners. One was already in place, and we suggested a 70-cent valuation multiple in that case. And then we use the equity method for the allocation of just tangible equity. With that, I'm going to go to our final polling question. Nikki?
Okay. This one is about your approach to valuing your owner's interest in the firm. Is it fair and affordable? Fair, but you're not sure you can afford it? It's not fair because it's too high, not fair because it's too low, or does this not apply to you because you don't have an agreement? This, of course, is our 4th and final question today. I'll give it just a few more seconds. We've got nearly everyone, but not quite. Okay, so 44% are in that category where it doesn't apply to them. They don't have an agreement, but 31% say it's fair and affordable. 19% fair, but not sure they can afford it. And then the remaining 6% not fair because it's too low.
Okay. I'm going to guess the ones that think it's too low are the sellers. Suggested additional info. We have, you can go to our website, and there are several, there's lots of webinars actually that are recorded from previous webinars that we've presented. These are 3 that are examples of those that you might consider if you're interested in these topics. You can also download dozens of articles that we've written. We've written roughly 28 articles for the Journal of Accountancy, and these are 3 that are fairly recent. That the top one is the one I mentioned that describes the unit approach that I recommended you look at. We also recommend that you consider using the AICPA Succession Planning Resource Center. We've had a big hand in developing the content that's on that website. I'm a member of the CPA Consultants Alliance, which is made up of these other consultants to the profession, and covers all different kinds of disciplines within the consulting. And one of our goals is to provide content to the CPA profession of topics of interest. We wrote a book, this book, that you can obtain from the CPA Trendlines website. We also write white papers, and we're just released yesterday our latest one, How to Beat the Robots, which is a white paper that's designed to discuss the transition that CPA firms need to make from being strictly compliance oriented to consulting, as the trends in our industry are changing dramatically, and because of AI and blockchain and all kinds of technology, and different shifts in the economy. This is the contact information for me if you're interested in having any questions you want me to address, and appreciate your attendance in the webinar today. Nikki?
Hey, thanks so much, Terry. Just a reminder, there will be a survey that'll pop up right after the session ends. If for some reason you don't see that, or if you have to get going and need to complete the survey later, just send me an email. You can reach me by replying to those messages that you got from GoToWebinar. I can send you a link to do it after the fact. As long as your survey is completed by the end of the week, I'll have your CPE certificate to you by the end of the week as well. Thanks so much for attending. Thank you, Terry, and everyone have a great afternoon.